If you were talking to somebody who never had a credit card or credit score or credit in their lives, how would you explain to them what a credit score is?
So your credit score is essentially your financial GPA. It's taking up all the classes that you have. It's going to give you a score between 300 to 850. 850 is like A++. 300, we got some work to do. And really it's telling all of the folks that you have, like, how good are you at managing that credit? Are you somebody that is good with credit and able to pay it on time, or somebody that, takes a while, is going to take a long time, and so you're riskier?
So if your credit score is kind of like your GPA for like borrowing money, what exactly is being graded? Like, what are you being graded on in order to get this GPA?
Great question. So there are 5 things that you are being graded on within your financial GPA. The first is your payment history. So making sure that you are making on-time payments, that's the one that's going to count for the most points. And then we have credit utilization. They don't want you to max out your credit card. So we want to make sure that we're coming under 30% of what your available credit is so that you get the most amount of points. The third thing is the length of credit history. So how long have you had a credit card? Has it been 2 years, 5 years, 10 years? The longer that you have credit history, the better it is for your score. And then the next factor is your new credit opened. So have you opened up a credit loan or anything like that in the recent weeks or recent months? That's going to impact your score. So we want to be mindful that we're not opening up too many things at once. And then the last thing is the type of credit that you have. So do you have a credit in terms of like revolving credit? So like a credit card? Do you have a mortgage? Do you have a car loan? All of these different things are very helpful in terms of them seeing that you have kind of like a mixed bag. Not to say that you need to go out and start opening up different types of loans out there, but it is part of that score.
Now, why should you care about your credit score? Like, who is going to check it and for what?
There's a few reasons why it would be really important to have a good credit score. So the first that comes to mind is access to favorable credit terms. So when you go to a place where you're like, okay, I want to buy a home, or I want to get a car, or I need a loan for something, it's going to be really important to make sure that you have a good and a high credit score to make sure that you're getting, a loan that actually has a lower interest rate or just better terms for you in terms of being able to pay it off without having to pay extra money for it. Another reason why it's really important to have a good credit score is it can actually affect like rental applications or like employment ramifications, right? So like if you're actually applying to live somewhere, they're going to check your credit score because they want to know that you're going to pay their rent on time. So there's a few reasons why it would be helpful to have a good credit score. And then even for employment too, like if you're working in banks or with a lot of money, they might run your credit to make sure that you're somebody that's trustworthy with money in general.
What are some of the things that you would recommend to like stay away from doing these things because they actually make your credit score drop?
A top tip that I would say for somebody that is getting into the credit card game is make sure that you are paying it on time. And then the second thing is that you don't need to pay interest in order to get a good credit score. So make sure that you're paying it off in full so that you are really maximizing the benefits of your credit. Another thing that you really want to avoid is opening and closing accounts too quickly. So what I mean by that is going back to that credit history. You don't want to, do all of this great work, paying the credit card off on time, making consistent payments, and then just like completely wipe it off your report by closing the card. That can really impact your score. So we don't want to put on all this effort and then have it, be erased. So opening and closing credit cards back to back would not recommend. Make sure that you have one credit card that you can stick with for a long while because that's going to help with your credit history in the long term.
So are there any like credit score myths or like information out there that's like misinformation? It's like clearly is not true, but like a lot of people tend to believe it and you wish you could just like erase these myths forever.
Yes. A myth that I would see right now is that paying interest is a good thing. I have heard like that it's like, oh, I'm showing that I'm paying it, so I'm going to carry a balance month after month, and I'll just pay the minimum so that they know that I'm staying on top of my payments. Paying the minimum is part of those like debt traps. We don't want to pay the minimum. We want to pay it off because you can still play the credit game and get a good score without necessarily having to pay extra dollars of your precious money towards interest and still have a good credit score. So paying interest does not equal having a high credit score.
The reality is when you pay the interest fees, that doesn't do anything to boost up your credit score.
It does nothing to boost up your credit score, and it does nothing to boost up your bank account because you're just spending money like without really the need for it, you know? Right. So like you can definitely play the game and play it smart. We want to play the game smart.
Here are some vocabulary words for today's episode. Credit bureau. This is a company that collects all the data that gets used to create and calculate your credit score. The 3 credit bureaus are Equifax, Experian, and TransUnion. Credit history. This is all of the data associated with any debts in your name and how you've repaid those over time. So this includes things like credit cards and loans. Credit limit. This is the maximum amount that you can spend on your credit card. For example, my very first credit card had $500 on it, so I could not spend more than that amount. But a few years later, they raised my credit limit to a higher amount because I always paid my bills on time. Credit utilization or credit usage. This is how much of your total credit limit you're using right now. And it's calculated as a percentage out of your total available credit. So for example, my credit card has a $1,000 credit limit and I've spent $500. So I'm utilizing 50% of my available credit limit. This is actually really bad. Most experts say you should keep your credit usage under 30%. So today we learned all about credit, and I know this can be confusing. So let's talk about why do we even need a system like this? Now, my experience with credit for the first time was back when I was a little girl. I would run errands for my parents, like I would run to the bodega or the corner store, and I would pick up things like eggs and bread and milk. But my dad, he would be at work, so we didn't have like money until he got back. But luckily, the owner of the bodega, he actually knew my parents and trusted us. So he would let me take the eggs and the bread and everything without paying for it. But he would write in a notebook exactly what I took and how much it cost. So later on, when my dad would come back from work, he could pay him back. But think about it. If the bodega owner didn't know you or your parents, he wouldn't really trust you to get things on credit. Or what if him and my dad got into an argument, then he decided to stop giving us credit? Or maybe he might discriminate against somebody because of their skin color, right? So you could see how a system like this could get unfair really quickly. Now, this was just my local bodega, local store, right? Imagine huge companies or corporations. How are they supposed to have these personal relationships with every customer so they can know who to trust and who not to trust? It's just not realistic, right? So this is why there was a really strong need for a system that could standardize who gets to borrow credit for what and how much. Now, in the late 1800s, companies called credit bureaus started to collect information about people's debts and whether they repaid their debts or not, right? And then they could use this data and sell it to landlords, employers, or stores to help those folks make decisions about whether they could trust you and lend you money or not. In theory, this was solving a problem, right? Instead of judging people based on personal feelings about them, they had to use an objective number calculated using all the data from the credit bureaus. And the idea is that numbers don't lie, but they kind of still did lie. There was still a lot of discrimination that was built into those early credit score formulas, right? So, for example, it was really hard for Black Americans to get loans to buy a home or to start their business because they would actually get less points just for being Black, right? So clearly there needed to be major changes, and there have been major changes to reform the credit system in America and make it more fair. So, for example, the Equal Credit Opportunity Act in 1974 made this type of discrimination illegal. So the credit scoring bureaus and other companies, they're not allowed to count your race, your sex, marital status when it comes to calculating your credit score or deciding whether or not they're going to lend you money. So basically, our credit scoring system now is still not perfect, but it is a whole lot better and way more fair than what came before it.